Great that you could join me on the latest episode of the Everyday Investor. And Happy New Year if you're listening to this one fresh out of the box here in January 2024. With regards to property, we generally will have the expectation that over the long term, we'll be able to sell a home for more than what we paid for it. Perhaps we own property for the simple purpose of providing a roof over our heads. Perhaps we depend on a strategy of price appreciation that occurs at a rate that exceeds our overall holding costs. We're exploiting the fact that property values go up over time. Regardless of our goal, though, be it accommodation or aiming at a financial gain, there's one very simple relationship that we should study. Interest rates and property values are inversely correlated. When one decreases, the other one generally increases. That's one of the reasons why I obsess a lot about interest rates and everything that affects interest rates. History is a great teacher as well. Speculating on whether or not the next 40 years will be similar with respect to decreasing interest rates and doubling values every 7 to 10 years is probably beyond this episode, but let's assume for a moment that the past will persist into the future, into your future. A $1 million home today would, in theory, be worth $2 million at least in 10 years' time, or $4 million in 20 years, and $16 million in 40 years' time. What would this look like if that was you living in a property worth that much, yet struggling, as many retirees today do, to afford a simple hip operation or a car replacement or a trip overseas? How do we solve the equity-rich, cash-poor dilemma? Well, option one involves selling that property and downgrading in price to release a pile of cash to live off of. Option two, though, which is the subject of today, involves taking out a reverse mortgage. Today, I'm talking with Keira Billot, General Manager of Retail Banking at Heartland Bank. I'm talking to her specifically about their reverse mortgage product. Way back in episode 106, I spoke also with SBS on the same topic. You can check out that in the show notes if that's of interest. SBS and Heartland Bank, by the way, are the two lenders that I'm aware of that you can access a reverse mortgage from here in New Zealand. Now, a reverse mortgage buys time in a home, which is great for people not yet ready to move on. It can also unlock equity in a home that can be used to assist kids with getting a foothold into the property market themselves. Done right, and obviously with advice, reverse mortgages can solve the equity-rich, cash-poor dilemma for some people. If this is something that you would like to investigate, either for yourself or for your parents, there's a link in the notes that you can click on to arrange a call with me to discuss in a bit more detail what the options are before you reach out directly to those lenders. All right, it's a short episode today, so let's get started. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around. How are you, Keira?
I'm good, thank you. How are you today?
Not too bad. Thank you for agreeing to catch up with me and having a chat around today's topic. It's a bit of an interesting one. Normally, with the people that I generally talk to in my day job, we're talking about getting a mortgage and then getting rid of it. But today, we're going to be talking about kind of like the opposite, right? Like, when is it appropriate to get a reverse mortgage? So to start off with, can you just tell me a little bit about what a reverse mortgage is?
Absolutely. Essentially, a reverse mortgage is a product that's been designed specifically for the needs of people who are over 60. So it provides them with greater financial freedom by releasing equity that's held in their home, therefore being able to live a more comfortable retirement. The amount that they can borrow depends on certain factors, such as their age, the value of the property, and they're also not required to make any repayments. So that's a key difference to a normal mortgage. So there's no repayment requirements. The loan, including the accumulated interest, is repayable when they permanently move from the home. And that's usually when the property is sold, they move into long-term care, or the customers to pass away.
Basically, from the age of 60, you can borrow from the age of 60, you can borrow, is it 20%? And then that scales all the way up to 50% if you get to age 90. Is that more or less correct?
The LVR ratio is based on age minus 40. There's also other scaling depending on where the property is, what the market risk is, the type of the property and things like that as well. So when is to apply, we look at all the specific aspects of their scenario, and we'll advise them based on what their maximum lending option is, and they can choose to take that. And we often find that customers don't lend as much as they can. They can take out an initial drawdown amount and then keep the rest, or what they choose to keep in a cash reserve facility, which doesn't accumulate interest until it's drawn down as well. So it's not quoting this, but line of credit sort of thing, so they can
Sure.
pull things out as they need as well.
Okay, but I'll quote it because you can't quote it, but it's kind of like a revolving line of credit. So there's a few different types, right? So it can work as either like a lump sum, an amount that's there and able to be drawn down. That's your revolving line of credit kind of thing. Or can you set up also like a regular payment that gets paid to you, kind of like almost creating a synthetic form of income? Is that kind of how it works?
The different options with a reverse mortgage is to get a lump sum initial drawdown, and that's a minimum of $5,000. The other option is to supplement, and you can do both of these as well if you're able to supplement retirement income. So we've got an option called the Easy Living Monthly Advance. That means that customers can get a certain amount each month to help top up their retirement income, which we've found has been increasingly popular these days, with New Zealand super just not being enough for people. And the other option is we have that cash reserve facility, which is there and available for when in which the customer wants to draw down on it. There is another option called a streamline loan, which is a bit of a more simplified application process and doesn't require a full valuation done, and there's a maximum cap of $100,000 that can be lent on that as well. So when a customer is to apply, we'll talk through them to understand what their needs are, and make recommendations based on what we think is suitable for them.
Yeah, and I guess everybody that would come to you guys and ask for a reverse mortgage facility, they'll have different circumstances, different needs, but what would be the typical reason why people would come to you? So let's say I was over 60 years old, typical reverse mortgage customer. What are some of the reasons why people are inquiring about it?
The most common reason that people are taking out a reverse mortgage, and it's held this position very strongly over a period of time, is being for home improvements. That's doing things like renovating or adapting the home so they can continue to live in it, maintenance. As we've seen this cost of living increase over recent times as well, we've also seen a steady incline in people taking out a reverse mortgage to consolidate debt or to repay off other loans. So things where they're required to make repayments on, like an existing home loan or credit cards. So clearing that out and then accessing a reverse mortgage to not have to make those monthly repayments and just be able to enjoy their retirement. We also see people using it to top up their monthly income so that they can do those things like go to the hairdresser, have that coffee, go for lunch, just do all the nice things that might be out of reach if they were living off that essential income only that they were getting through. Medical expenses, travel. We also see some family support and things like that coming through as well. So
would you rate that family support one that you mentioned there? That might be where they want to raise some money to give to the kids to help them with a deposit for their first home, for example. Would you say that that's kind of one of the less common things that you see, or is that almost as common as some of the other ones?
That's definitely less common. We do robustly talk to them about if there's a gifting element to it as well, just to ensure that it's all under the right circumstances and that there's no vulnerability there with the customer as well. So we just make sure, if they are giving that way, that it's for the right reasons.
Okay, so it's not just like, hey, we're going to allow you to borrow some money that you can actually never really repay unless you sell your home. It's not like that. There's a lot of questioning and probing, making sure that it's suitable for the circumstances, that there's limited hardship that potentially could come as a result of this. But there's other things that you can't control. But what would be the normal way that you would recommend people kind of investigate it? Like I noticed that there was a lot of information on the website. There's a little ebook almost that you can download for free to learn all about it. But what would be the normal way, or the very first thing that people should do before they actually reach out to you guys?
The first points of interest that we get is people downloading our Insights Guide. And that's something that we developed, but it's not Heartland centric. It was really something that we, with Consumer Trusted, talked about having out there in New Zealand to help explain what a reverse mortgage is. Whilst it has been developed by Heartland, it just talks more generally around, the product, how it works, all that sort of stuff too. And then on, our website, we do have more specific things like our fact sheet, the product information about, fees, all that sort of stuff. So there's lots of information on there. The other steps in regards to the application process is that we require our customers to have a conversation with family members. We also recommend that they talk to a financial advisor. That's not mandatory, but it is mandatory to get legal advice throughout the application process as well.
So with the reverse mortgage type facility, you're not necessarily looking for income, because we're talking generally about people who are retired or they're not necessarily working anymore. What are some of the general eligibility criteria for this product?
It's not a debt servicing product, so we don't, do that debt servicing assessment. So essentially, homeowners need to be aged 60 and above. In the situation of a joint applicant, if one is over 60 and the other is 55, we will consider that as well. The property must be residential and of conventional construction and good nick. And it must meet our minimum property criteria in regards to valuation, size, location, all those sorts of things that mean that the property will be able to be sold and, have an outcome at the end of the day as well. The property should be mortgage-free, it needs to be mortgage-free. And if it does have a mortgage on it, what we normally do is use the reverse mortgage to pay off the remains of what's outstanding on the home loan. Optionality includes that it's owner-occupied, and it can be an investment property or a holiday home as well. So we do second.
Okay. So you're saying that you can actually, if you had a batch, a holiday home, or if you have an investment property, which is totally debt-free, and you don't want to touch your existing home, then that debt-free holiday home could be used instead.
Yeah, absolutely. And, we do realize that within the demographic as well, there is a volume of people that do have the batch or, the holiday home as an option. So, and as security for the loan, Heartland must be listed as the first and only mortgagee on the property. So that means that borrowers will be unable to take out another mortgage or charge on their home, in that period of time. How that works, though, is the owner will remain the owner and be able to remain living in the property, and the option to sell, remains their choice and all that. So we would never ask them to leave the property.
And why would you, right? Like if you're only going to be lending between 20 to 50%, of course, property values could decline consistently or dramatically over time. That's definitely a possibility. But if you're only lending between 20 to 50% more or less, and you're only lending the large amounts when they're relatively older, in brackets, closer to death, then really it's not like you're taking a massive risk before that debt is going to be repaid. So I guess you don't really need to be that gnarly around getting people to pay down that debt, because it's just going to capitalize, or the interest payments just snowball or balloon or accumulate over time. That's kind of the idea, right? Is that you've taken a risk-based approach rather than a traditional mainstream lending approach where you're analyzing the income.
Yeah, absolutely. It does, as the loan spends time in its tenure, the interest compounds and accumulates over time. what we've done is put together some protections for our customers, just to make sure that they feel safe in what they are entering into. And that includes our lifetime occupancy promise that I just mentioned as well. So that means that they continue to own the home 100% for as long as they choose. We also have a no negative equity guarantee. So what that means is the amount to repay the loan, so the amount the customer owes us, will never exceed the net sales of the property. So they'll never owe us more than what they get, from the sale of the property. Okay. We also have an equity protection option. So that means that customers can choose to protect a percentage of equity in their home up to 50%. That's put aside so that, we're not going to tap into that too, so that they can retain that.
Do those guarantees work just by limiting the amount that people can pull down? Well, let's say there is a customer who's borrowing 50% on a mortgage, on a reverse mortgage facility, and the property market tanks by like 70%. Is that when the lender, in this case, Heartland, would be wearing some of that cost? How does that guarantee actually work?
Absolutely. So what we do is we do portfolio analysis and apply this methodology in all different sorts of circumstances to understand, in this sort of housing market, if these things were to happen, what does that mean to the portfolio and the potential risk and impact to Heartland? The risk is on Heartland. It's really just providing them a protection and a guarantee. And look, the average initial LVR that we see is usually in the 9% range, as opposed to it being high.
Okay, so the average loan that you guys would normally see as a reverse mortgage would only be 9% of the property value. That's on average.
Yeah.
Wow. Okay, that's pretty safe. Well, I shouldn't say it's pretty safe. Nothing is safe. Nothing is guaranteed in this world, but that's pretty good.
Because our average loan tenure is around 7 years. So, you can do the math. We don't have people taking out 25% of the property value and keeping it on for 25 years, because obviously that's quite a different scenario for them.
Going back to how it works, you can get a lump sum right away. That lump sum could be used to get rid of a mortgage that you haven't fully managed to repay, like a traditional mortgage, or it could be used to help the kids out or medical stuff, upgrade the car, travel, whatever. You can have some approved but not drawn down credit. Correct. And that's kind of like a revolving line of credit, but it isn't. And that means that you don't have to go through the hassle of the setup. It is there, it's on tap, but you're not paying for it until you use it.
Yeah.
And then you have a facility where you could administer regular drawdowns, like a synthetic or simulated income that comes from the equity in their home. Those are the three main ways that you can do it, right?
That's correct.
Getting there. All right. So let's just broadly kind of think about the people that might be listening. I'm kind of thinking about the people that I typically talk to from this podcast would be, somewhere between, say, 35 to 55 years old. And this might not necessarily be suitable for them yet, unless they're thinking, hey, we do have limited options here and we might access this in the future. So that's something that they might just put on the shelf for future use. But I'm kind of thinking more specifically that they have parents that are in an equity rich, cash poor situation. And they might need to have that initial conversation with the parents around what some of their options are. So just really broadly speaking, can we talk about the pros and cons a little bit? Like, what would be the advantages, firstly, of a reverse mortgage in the language that the kids might use to talk to their parents, if that makes sense?
Yeah, look, I think the number one advantage for a reverse mortgage, and I'll say that there are many, is that the individual is able to stay in their home that they know, their community, around their friends, and age in place. That's something that our customers really value and find so important. So I'd say the biggest benefit for people. And then we kind of get into other things like the financial pressure that it can help relieve too. So those things that we've talked about many times throughout this discussion, those cost of living pressures, those access to things that they might not be able to easily get access to, like a updated car, like medical care that they need, like the home maintenance or putting in accessibility features in their home, so that they can be more comfortable in their environment and stuff as well, really makes a difference for people, and providing them with more financial freedom just to be able to have that independence and do those things. And enjoy a retirement they've worked so hard their whole life for.
And then on the other side of the coin, what are some of, and it might be kind of obvious, I guess, like one of them is that, hey, you now have a debt on a property that you probably worked your entire life to get debt free. And we're kind of turning our back on that. But apart from that obvious negative or con, around getting a reverse mortgage, what are some of the other cons associated with getting a reverse mortgage?
The one thing that probably is quite obvious is the interest rate is higher, and it's higher for a reason. And that reason is that it is, whilst it does get compared to a normal home loan, it isn't a normal home loan. There's no repayment requirements for the lifetime of the loan. So therefore, the lender is taking a lot of risk in regards to what it's putting out there, because we don't know at the end of the day how long that loan's going to last. There's also a floating element to that too. They can pay it off sooner as well.
And what is that at the moment, acknowledging the fact that it's a floating mortgage rate? So obviously it's going to go up and it's going to go down. So this isn't going to age well, this question, but just as a reference point, what is the rate currently?
Yeah, so we're currently sitting at 9.98%. Like everyone else, we are hoping to start to see that trajectory change in the new year as well. So
it gives you a feeling for it, doesn't it? Because I guess if it was a 10% interest rate and someone drew down a $100,000 reverse mortgage, roughly in just over 7 years, that $100,000 has now doubled. So roughly. And as time goes on, if the interest rates go down, then you're getting a longer period of time before that debt accumulates that size. Again, this is all about referencing the negatives in light of the positives, right? Like if that enables you to stay in the home that you like for another 5, 10, 15 years, then why wouldn't you sacrifice that? Yeah, well, you might have wanted to die and pass that on to the kids. But if you've had that conversation with the kids and the kids are like, well, we don't really want that, mom and dad, we just want you guys to live and be happy, then that's kind of the conversation that probably needs to be had up front, right?
Yeah, we've got a loan projection calculator on our website, so people can go in there and have a play with different numbers. So you can get some scenario projections based on what would it be at this point in time if it was, if this was the rate and this was the market growth. And the family member conversation is important for us too. So as I said earlier, we recommend to our customers that they do talk to family members. And then we ask them again, down the track if they have spoken to family and, how the conversation went and stuff as well.
That's really important. Okay. And so other fees, expenses that people should be aware of, apart from the fact that, the interest rate is definitely higher. Is there other major fees that people should be aware of from the outset?
There's arrangement type fees and they can be added to the loan. So customers don't necessarily need to come up with the money. There would be legal fees, which again can be added to the loan if the customer doesn't have the cash available. If it's not a streamlined loan, which doesn't require a full valuation, then the property will need to get a full valuation, which varies in cost too.
Okay. So just a couple of what ifs here, and we'll come in for a landing on this one. What if, you mentioned at the very start, by the way, that if one borrower is 60 and the other one is 55, you might consider that on a case by case basis in terms of minimum age. What if someone was like 80 and they had a 40-year-old partner? I know it sounds crazy, but I've seen this. So how would that be interpreted?
That would not be acceptable in our lending standards. If
yeah. It might not be acceptable around the Christmas table dinner either, but if that was happening, I guess that's something that you probably want to just throw that off the agenda right away, right?
Yeah, so we and look, we've seen variations of things like that as well in our time, but we do have very robust lending standards that applied to every lend that we do as well.
Yeah. Okay. What happens then if one borrower dies? Let's say there's a couple who both of them are 70, one of them passes away at the age of 70. Does everything just keep on continuing on like normal, or is there any event that occurs?
Yeah, look, the couple, the partner that is still alive can remain in the property, and then obviously be the sole person listed on the loan from that point, and then that will continue until they themselves pass away or move out and sell the property. But we wouldn't discontinue their ability to stay in the property if someone was to pass away.
And what about if it's a family trust?
So we do lend in trust scenarios as well. They're a little bit more complex in the upfront requirements, AML side of things and all that, as you'd expect with a trust. But we do definitely we are seeing an increasing amount of those come through.
And so if both borrowers then pass away, like that's obviously the end of the line for them, what happens with the reverse mortgage that's probably grown at that stage to the maximum point that it will ever be? There's nobody living in the property anymore. They're gone, right? And maybe it's the kids who inherit the mess, not the mess, but the rest. What happens from Heartland's point of view or the reverse mortgage provider's point of view? What happens there?
So it would go into the process of the property requiring to be sold, the estate management side of things. So there's a period of time, I think it's 12 months, which the properties were required to be sold.
All right, so it's pretty straightforward, though. I think, and from the outset, we talked about this, that maybe the best way to order this would be, if this is of interest, the first thing is to make sure there's a conversation with family, then get some advice. That's where a financial advisor like myself can definitely come in, or legal advice, which will be required throughout the process anyway. And then Heartland, that conversation can be initiated at the start or after there's been some initial advice anyway. But is that kind of like the main 3 steps? Talk to family, get some advice, then deal with you guys if they want to take it further?
Research is important. Talk to people, read things, talk to us. We've got a very specialist team here who are incredibly passionate about the customers, first and foremost, know the product really well, are more than happy to, have a discussion around options. And the specialist team manages that end to end throughout the process.
All right. Well, thank you very much, Keira, for your time today. That was interesting. And I think like a lot of people listening to this, again, if it's not for them, it might be for them in the future, but it might also be for their parents right now. So it's just an interesting solution, I think, to solve that equity rich, cash poor problem that I know I myself have been a little bit cynical on this in the past, but increasingly I think it's starting to look like quite a valid tool that people should be exploring at the very least as an option. So yeah, thank you very much, Keira, for your time, and we'll get you again soon.
All right. Thank you.
All right. Cheers.
Bye.
Hey, thanks for listening into this episode today. Just a reminder that if you are seriously thinking about a reverse mortgage facility, either for yourself or for your family, please do keep in mind those 3 things. Have an open and frank discussion with the family. Make sure that you reach out for some financial advice as well. In the notes will be a link to click on where you can make a time to have a conversation with me at no charge. And I can have a quick chat with you to discuss whether or not a reverse mortgage sounds like a suitable option for you. And then the third thing to do would then be to reach out to one of the reverse mortgage providers here in New Zealand. We'll get you on the next one. Thanks for listening into the Everyday Investor Podcast. Like what you've heard, but you want more? Make sure that you've subscribed to our YouTube channel and subscribe to the Everyday Investor newsletter too. The links for everything are found in the show notes that you can access easily by swiping or tapping over the cover art in your podcast player. If you received value in some way, I'd love it if you could take the time to write a review wherever you listen to podcasts. Share it with a friend, or think of our show partners where appropriate. Easy Crypto, the safe and easy way to buy and sell crypto in New Zealand. Gorilla Technology, increasing business success through innovative and strategic IT solutions. And Ungaro & Co. Financial advice for everyday people building everyday wealth. Remember, some investments or strategies discussed on these episodes may result in financial loss. Be sure to do your own research and ideally seek qualified advice of your own before making investment decisions. Hope you enjoyed today's episode, and we'll catch you next time around.